Financing Your Business, Strategies and Success Stories. Presented by Murphy Publication. Introduction. Starting and growing a business is an exhilarating journey, but the road to success often requires significant financial backing. Whether you are launching a startup or scaling an established business, finding the right financial resources is critical. This book aims to equip entrepreneurs with practical strategies for financing their ventures and shares inspiring success stories of those who have navigated this challenging terrain. With the right knowledge and approach, business financing doesn't have to be an obstacle, it can be the catalyst that propels your business to new heights. Chapter 1. Understanding business financing. Before diving into financing strategies, it's crucial to understand the basics of business financing. Business financing refers to the funds that businesses use to start, operate, or expand. These funds can come from a variety of sources, including personal savings, loans, investors, or government grants. Financing is typically divided into two broad categories: debt financing. This involves borrowing money that must be repaid, typically with interest. Common examples include bank loans, credit lines, or bond issuance. Equity financing. This involves raising capital by selling shares of the company. Unlike debt, equity financing does not need to be repaid, but it does dilute ownership. Businesses often use a mix of debt and equity financing to meet their needs. The key is choosing the right combination to maintain control of your company while ensuring you have enough capital to grow. Chapter 2. Bootstrapping. The power of self-financing. Some entrepreneurs choose to finance their businesses without external help, a strategy known as bootstrapping. This involves using personal savings or reinvesting the company's earnings. While it allows founders to maintain full control over their company, it also requires immense discipline and can limit the speed of growth. Success story. Sarah Blakely and Spencer Blakely started Spanx with just $5,000 of her own savings, turning her personal investment into $1 billion business. Blakely's success was driven by a focus on frugality, careful spending, and relentless belief in her product. Bootstrapping allowed her to retain 100% ownership and full control over the brand. Advantages of bootstrapping: full control and ownership of the company. No repayment obligations or investor pressure. Challenges: limited funds, which can restrict growth. Increased personal financial risk. Chapter 3. Small business loans and credit. Debt financing is one of the most common ways to fund a business. The key to success with loans is securing favorable terms and ensuring you have a solid plan for repayment. Traditional loans are typically obtained from banks or financial institutions, but new online lending platforms have emerged in recent years, offering faster, easier approval processes. Types of small business loans: term loans, a lump sum repaid over a fixed period with interest; lines of credit, a revolving credit facility that allows you to borrow as needed; SPA loans, backed by the Small Business Administration. These loans offer low interest rates and favorable repayment terms. Success story. Kabbage and Alternative Lending. Founded in 2008, Kabbage revolutionized small business lending by providing quick access to working capital through its online platform. Many small businesses that were unable to secure traditional loans turned to Kabbage, which used real-time data from their businesses to assess creditworthiness. This opened doors for countless small business owners who needed fast, flexible funding. Benefits of loans: ability to maintain ownership, predictable repayment structure. Challenges: risk of accumulating debt, high interest rates for lower credit scores. Chapter 4. Attracting investors, angel investors and venture capital. For businesses with high growth potential, equity financing may be a better option than debt. Angel investors and venture capitalists (VCs) provide capital in exchange for a share of ownership in the company. While this can mean giving up some control, the right investors can bring invaluable expertise and connections. Angel investors vs. venture capitalists. Angel investors, individuals who invest their own money in early-stage startups. Angels typically invest smaller amounts, but are often more flexible in their terms. Venture capitalists, firms that pool money from multiple investors to invest in companies with high growth potential. VCs often invest larger sums, but require more control over the business. Success story. Airbnb's VC journey. When Airbnb started, the founders struggled to raise money. However, after being accepted into Y Combinator, one of the world's most prestigious startup accelerators, they received a small seed investment. This led to a series of successful funding rounds, including investments from Sequoia Capital and Andreessen Horowitz. Today, Airbnb is a multi-billion-dollar company, proving that VC funding can unlock rapid growth. Benefits: access to large amounts of capital. Investors bring expertise, mentorship, and networking opportunities. Challenges: loss of some ownership and control. Pressure to achieve fast growth. Chapter 5: Crowdfunding. Tapping into the power of the crowdfunding has emerged as a popular way for businesses to raise capital by appealing directly to consumers through online platforms like Kickstarter, Indiegogo, and GoFundMe. This method allows entrepreneurs to test their product's market appeal while raising money from a large pool of small investors. Types of crowdfunding: rewards-based crowdfunding. Backers receive a product or service in exchange for their contribution. Equity crowdfunding. Investors receive shares in the company in exchange for their investment. Success story: Pebble Smartwatch. Pebble, a pioneer in the smartwatch industry, set out to raise $100,000 on Kickstarter. In less than a month, they raised over $10 million, making it one of the most successful crowdfunding campaigns in history. Crowdfunding allowed Pebble to bypass traditional financing and validate their product before bringing it to market. Benefits: access to capital without giving up equity or incurring debt. Great for testing product ideas and building a loyal customer base. Challenges: requires strong marketing efforts to stand out. Potential for public failure if the funding goal is not met. Chapter 6: Government grants and assistance programs. Many governments offer grants, subsidies, and other financial assistance to help businesses thrive. While these funds don't need to be repaid, they often come with strict eligibility criteria and can be competitive. Types of government financing: grants, funds that don't need to be repaid but are often restricted to specific industries or purposes, for example innovation, sustainability. Subsidized loans, loans with lower interest rates, backed by the government. Tax incentives, tax breaks or credits offered to businesses in certain sectors or locations. Success story: Tesla's federal loan. Tesla, the electric vehicle company, received a $465 million loan from the U.S. Department of Energy in 2010. This helped Tesla develop its Model S and achieve profitability. Tesla repaid the loan ahead of schedule, demonstrating how government support can spur innovation in emerging industries. Benefits: no repayment required for grants, can provide significant financial support for specific projects. Challenges: complex application processes. Highly competitive, with limited availability. Chapter 7: Strategic partnerships and joint ventures. Another innovative way to finance your business is through strategic partnerships or joint ventures. These involve collaborating with other companies to share resources, expertise, and capital. Success story: Coca-Cola and Monster Beverage Corporation. In 2014, Coca-Cola acquired a 16.7% stake in Monster Beverage Corporation, giving Monster access to Coca-Cola's vast distribution network. This strategic partnership allowed Monster to expand globally while giving Coca-Cola a stronger presence in the energy drink market. Benefits: access to new markets, resources, and expertise. Can significantly reduce costs by sharing expenses. Challenges: complex agreements that require careful negotiation. Potential for conflicts if goals are not aligned. Conclusion: charting your path to financial success. Financing your business is one of the most critical decisions you'll face as an entrepreneur. Whether you choose to bootstrap, seek loans, attract investors, or pursue government grants, the key is to align your financial strategy with your long-term business goals. Every success story started with the right financial foundation, and with careful planning, your business can be the next to thrive. Remember, there is no one-size-fits-all solution. The most successful entrepreneurs are those who remain flexible, continually reassess their financial needs, and aren't afraid to explore new financing options. Murphy Publication wishes you the best of luck on your business journey. Here's to your success. Glossary: bootstrap, self-funding a business without external investment. Angel investor, an individual who provides capital for a business startup, usually in exchange for ownership equity. Venture capital, financing provided to startups and small businesses with high growth potential. Crowdfunding, raising small amounts of money from a large number of people, typically via the internet. SPA loans, loans offered by banks but guaranteed by the Small Business Administration to reduce the risk to lenders. Thank you for joining us today. If you found this video helpful, please give us a thumbs up, and don't forget to follow and subscribe for more insightful content. Until next time, keep learning and growing.